Hello there, everybody. Thanks for making the time today to join us for another episode of Market Sense. I'm Heather Hedges with Fidelity. It's been a volatile week in the markets with investors trying to make sense of the conflict with Iran and rising oil prices. There's a lot of uncertainty in the mix right now. We know that. And we understand that it makes it difficult for markets and investors to find their footing. So, to talk about these headlines and what they might mean for the bigger picture, we are fortunate to be joined today, as we often are, by Jurrien Timmer, who is Fidelity's Director of Global Macro. We're also welcoming a new face to the show today, Travis Furland, who is a Fidelity Vice President and a financial consultant here in the Boston area. And he's joining us today to talk about a common thread in the financial plans that he helps to build, and that is tax smart investing and strategies for keeping more of what you earn as we all get ready to file our annual tax returns. It's that time of year already. Travis, welcome to the show.
Thanks so much. Happy to be here.
Great to see you both. Travis, welcome.
Thank you, Jurrien.
Thanks to both of you for making the time. It is Tuesday, March 10th. We've got a lot to talk about. And Jurrien, before we get into those tax smart strategies, let's talk about that heightened volatility as investors react to the ongoing conflict with Iran. Oil prices at the height of this, just over the weekend, were at $100 a barrel, which is a psychological milestone. I think that number gets people's attention. And that's creating noticeable ripple effects across the broader energy sector. So this isn't the first geopolitical event that we have seen this year even, and yet the market reaction has been pretty strong, much stronger, one might argue, this time around. So how would you compare this to other geopolitical events that we have seen lately, Jurrien? And are the stakes higher this time?
It's a great question. And for the U.S., the stakes, I would say, are higher. Obviously, we don't want to diminish the human tragedy element of any geopolitical conflict, wherever it happens around the world. But, the financial markets are pretty detached and cold-blooded, if you will, about figuring out what do events mean for the markets, for the fundamentals, earnings, interest rates, monetary policy, et cetera, et cetera. So comparing, for instance, Venezuela to Iran, Venezuela was a strategy of basically decapitating the head of the snake. And that, was I guess it was, a success, and it didn't really move markets at all. And it was within the Western Hemisphere, which is, I guess maybe according to the U.S. administration, their sphere of influence, if you will. Iran, of course, is different because it is not in the sphere of influence, or at least not directly. There are a lot of other players involved, China, Russia. This is more of a global stage. And of course, as we are seeing in real time, it is affecting the flow of oil. And so, as you mentioned, oil prices actually briefly went to $108, very briefly. We're back to $80. So we went from like 70 to 108 back to 80 in a matter of a week. So, and that's not to say that we're not going to go back above 100 at some point, but this is about oil prices for the markets, because if the flow of oil stops, as it has right now, it creates supply chain bottlenecks for energy. And even though the U.S. is quite energy efficient, energy independent at this point, still oil is a global commodity. It impacts, of course, inflation and the price of things, as well as the supply. So that's what makes Iran, even though Iran and Venezuela both have oil, what makes this conflict different for the markets, again, is that it affects, obviously, the geopolitical structure, but also the flow of oil. And so that's what we're watching right now.
And what could it mean for the economy, Jurrien, and for the inflation outlook? Are we at risk of recession again? Is a recession risk back on the table?
It is, or at least the risk of a recession has been heightened relative to where it was 2 weeks ago. I still don't think we're going to be there. And according to our research, we're still in a mid-cycle type of expansion. But one word that's being brought back that we haven't heard in a long time is stagflation, right? So if economic output diminishes because, again, the gears are not running in terms of the flow of oil, then you could see a stagnation in the economy, while at the same time we could see prices rise, which of course the price of oil will do. So maybe a sustained rise in oil prices might add, let's say, 0.5% to the CPI. And maybe the lack of output takes off a few tenths of a percent of GDP. Not enough to maybe affect whether we're in expansion or contraction, but that would be stagflationary, all else being equal. And of course, nobody likes that. Nobody wants to go back to the 70s, although back in the 70s, people were much more sensitive to the price of energy than they are today, right? So the amount of our income or disposable income that we spend on gas prices, on heating, etc., is much lower today than it was 50 years ago. So this will not have the same impact as the oil shock of 1973 or 79. But still, at the margin, it could affect both growth and inflation, and that could have an impact, of course, on Fed policy. The Fed might be less inclined to cut rates if inflation is proving to be more stubborn. Again, not to the degree that I think it really upends the markets or the economy, but at the margin, it could have an impact.
All right. Well, the Fed's meeting next week, and no doubt we'll be watching this and talking about this next week as well, Jurrien. But I want to pivot right now. And as we continue to monitor those developments in Iran, also talk about another issue that is affecting all investors right now, and that is taxes. As we get ready to file our taxes in April, we're always looking for opportunities to try to talk through ways to save on taxes, not just when you're filing for the end of the year, but also year round. So that's why we asked Travis to come on the show today. And I think the key concept here, Travis, is it's not just what you earn, but it's what you keep after taxes. So let's start off this conversation by talking about the concept of asset location, because I know it's very important when you're buying stocks, bonds, ETFs, mutual funds, et cetera. It's important that they live in the right places, so to speak. So can you talk about, first of all, what makes the most sense in a brokerage account and what might work in tax-deferred accounts instead, like 401ks and IRAs?
It's a great place to start with brokerage accounts. And when I think about taxes, it's not just the end of the year or during tax time, it's all year. And really where I try to start with my families that I work with is asset location. And asset location is a tax management strategy that involves placing investments in the most tax-efficient account types to maximize after-tax returns. In a perfect world, you could hold all your investments in a tax-advantaged account, but in the real world, investors have limited space in their tax-advantaged accounts due to contribution limits or other reasons. So it makes sense to use your, tax-advantaged space to hold your most tax-inefficient assets, the things that would generate the biggest tax bill for you if they were held in a taxable account.
All right. And what investments are best suited for tax-deferred accounts?
Think of assets here that have the highest tax liability throughout the year. For example, by placing high tax inefficient assets like taxable bonds and retirement accounts and tax efficient assets like stocks and taxable accounts, investors can significantly reduce tax drag, potentially boosting their annual returns. And generally, the most tax efficient assets are investments like tax efficient index funds, ETFs, and municipal bonds. And these holdings are beneficial in brokerage accounts as they can be taxed at lower capital gains rates or provide tax-free interest income. And generally, the more tax-inefficient assets are things like corporate bonds or high-yield bonds or real estate investment trusts. And these investments are typically best held in IRAs or 401ks to avoid that annual income tax liability. And lastly, there are index mutual funds that offer tax advantages. They're less likely to distribute capital gains to shareholders because there's less turnover with the underlying holdings. The index only resets once a year, so it triggers less in capital gains.
Okay, so some investments are inherently more tax efficient or tax inefficient, conversely. Can you talk about some of the more tax efficient investments?
Well, people commonly think of long-term stock holdings and low turnover vehicles like index funds or ETFs. But another tax-efficient path people often overlook is direct indexing. Direct indexing is a strategy that looks to replicate an existing stock index like the S&P 500 through direct ownership of individual stocks, as opposed to an ETF or a mutual fund where you don't have direct ownership of individual stocks. And because investors have that direct ownership of individual securities in their portfolios, they gain unique opportunities for tax efficiency and personalization that may not be possible with ETFs and mutual funds. Direct indexing really provides an increased opportunity for tax loss harvesting of individual securities, which can help you capture additional tax alpha for individuals and families. The technology can enable clients as well more tax effective transition to personalized indexing. And here you also gain the transparency. You know what you own, and that's exactly what's in your portfolio. And finally, you can construct the completion of portfolios around your concentrated position at the individual security level to help improve diversification while minimizing the tax impact. And direct indexing can actively harvest losses. You can consider applying those losses against the gains realized from selling down a concentrated appreciated holding.
So direct indexing customizes your portfolio, so to speak, to drive tax efficiencies. So who might be, an ideal customer, the best customer for this kind of strategy, Travis?
You're right. And I face this all the time with my clients. I have an example. I have a client with a large position in one of the Mag 7 stocks, and he was looking for a way to diversify tax efficiently. And he implemented a direct indexing strategy alongside his concentrated position to help offset capital gains. So now he has the ability to tax harvest and manage his risk more effectively as he's better positioned to be diversified because he can sell his Mag 7 stocks sooner if he wants to buy other stocks without paying as much in taxes for selling. So someone like this is a good candidate for direct indexing. And currently, direct indexing is best suited for larger taxable accounts, but it's not appropriate for retirement or qualified accounts because you can't take advantage of the tax loss harvesting opportunity. And the decision to implement direct indexing, like the strategy itself, should be customized to you and your specific needs and goals. Clients with less than taxable assets, though, can still find that knowing what you own and being tax efficient along the way can benefit over time.
Helpful to keep in mind there, but great example there. So if somebody is interested in researching this concept of direct indexing further, just wanted to mention, folks, you can head to fidelity.com/direct indexing for more information on that specific kind of strategy. All right, Travis. So we've talked about asset location, which is important because you don't want to put tax efficient products inside a tax deferred account. That there would be no point in that. It defeats the purpose. Now that we've asset location squared away and direct indexing, I wanted to also pivot and talk about bonds and the best ways to manage some of the income and taxes on bonds. How can you use bonds most tax efficiently in a portfolio? And let's just start with corporate bonds. How can you maximize them?
Absolutely. And now that asset location is set, we can focus on different tax characteristics of bonds and how those characteristics shape where they tend to fit best. Each bond type behaves differently. So thinking about how they generate income and how that income is taxed can help maximize tax efficiency. So I'll start with corporate bonds. Interest from corporate bonds is generally taxed as ordinary income at both the federal and state level. Because the income has no inherent tax advantages, it's typically the least tax efficient of the three categories, but can offer a higher yield. Because the interest payments can be fully taxable, these bonds are often placed inside tax deferred accounts like 401ks or traditional IRAs, as well as tax-free accounts like Roth IRAs.
So what are the more tax efficient accounts when it comes to, or tax efficient kinds of bonds rather?
So when it comes to tax efficient bonds, think US Treasuries and municipal bonds. The yields are typically lower than corporate bonds, but they traditionally are considered to be less risky as they're backed by the US Treasury or local cities and towns. And there are some distinguishable tax advantages that come with both of these types of bonds. So I'll start with US Treasuries. Interest on US Treasuries is generally exempt from state and local taxes, but still subject to federal taxes on ordinary income or net investment income. But for investors in high tax rate states, these can be an efficient fixed income choice for your portfolio. As far as placement goes, Treasuries are flexible. Treasuries could go on both brokerage or tax deferred retirement accounts depending on your strategy or your tax rate. Placing Treasuries in a brokerage account is best if you're looking for tax efficient income, if you need liquidity or income that's exempt from taxes at the state and local levels as well. But Treasuries could also go into tax deferred accounts to avoid annual taxes on income. This is ideal for maximizing potential total return over the long term.
Well, you mentioned municipal bonds, and I know that they come with a triple tax advantage. So could you remind folks what that means, triple tax advantage, for anybody buying a muni from their home state, and what the advantages are with munis?
Of course, and I think because municipal bonds offer tax relief, they typically pay lower interest rates than other bonds, but Their tax treatment may make them more attractive, especially for high income earners who pay the highest ordinary income tax rates. So, municipal bond interest is tax free at the federal level, usually. If the bond is issued in your home state, the interest may also be exempt from state and local taxes too. So, for high orders, corporate bonds could be offering a higher yield, but a municipal bond may make more sense if you won't pay as much in taxes and that interest. And there's a great taxable equivalent yield calculator on fidelity.com to help figure out which bonds might generate the highest after tax interest for you, given your own particular tax rate. And it's worth mentioning again, you want your municipal bonds inside your taxable brokerage account because you don't want to miss out on those tax benefits. I'm challenged sometimes because I see my clients make this mistake, and more often than I'd like to admit, frankly, and they're wasting the tax advantage by having it in an account that's also tax advantaged.
Just want to level set here for a minute, Travis, and explain that, I want people to note that we've been focusing on how bond interest from your semi-annual payments is taxed. We're not talking about capital gains tax if you were to sell a bond at a higher price than you bought it for.
That's right. So if you sell a bond or a bond fund for more than you paid for it, you have to realize a capital gain. And capital gains on all types of bonds are generally fully taxable unless you hold the bond or bond fund in that tax advantage account.
All right, separate consideration there. All right, let's shift gears now from bonds now to talk about stock dividends. So how are stock dividends taxed, Travis? And what are some of the ways investors can approach dividends in a more tax-advantaged way?
This is an area where I really do see a lot of customer confusion. So thanks for giving me the opportunity to clear this up. Dividends are only taxed when they're held in taxable brokerage accounts, not in tax advantage accounts like an IRA or a 401k. So when they're taxed, they're considered either ordinary or qualified. And ordinary dividends are the most common type of dividend you'll see in a mutual fund. These dividends are paid out from the fund's earnings and profits. Some ordinary dividends can count as qualified dividends, which means they're taxed at a lower rate. That could apply to your long-term capital gains rate. Now, qualified dividends, on the other hand, they're taxed at your capital gains rate, which is typically lower than your ordinary income tax rate. And depending upon your income, that rate is 0, 15, or 20% at the federal level.
Hmm. All right, so how does an ordinary dividend become a qualified dividend to be able to access that lower tax rate, Travis?
A good question and a common one I get. For a dividend to be qualified, you must hold shares of the company for a specified period of time before receiving the payment without hedging the investment. And as an example, hedging is a strategy such as purchasing puts that can help manage the risk of potential losses in a single stock position. Now, there's different holding periods for common shares, preferred shares, and mutual funds. So consult with your financial advisor or tax advisor for those rules. If you want to know how your dividends are taxed, check your account statements or your tax documents for details.
All right, good rule of thumb. All right, so Travis, putting this all together now, when it comes to selling an investment or withdrawing from a taxable account, how should investors think about taxes when, considering which holdings to sell first?
Well, first, you want to start with the basics. What will trigger taxes in my account? And capital gains management is almost always the main focus. So for investors, you want to look at short and long-term gains. For short-term gains, investments held for less than a year, you'll get taxed at your ordinary income rate, which is likely higher than your capital gain rate. But if you hold that investment for longer than a year, you qualify for the long-term capital gains rate, which can either be 0, 15, or 20% depending upon your income. Tax loss harvesting is also an important strategy where you sell an investment that's down in value since you purchased it to realize a capital loss, and then use that loss to offset capital gains somewhere else in your portfolio.
All right, fantastic job there going through a lot of information, Travis. And just a note, if you at home watching or listening to us are a Fidelity customer, there is a tax loss harvesting tool that could be very useful for this. You can log onto your account and then head to fidelity.com/tax loss harvesting, which is hard to say, but it is tax loss harvesting, not lost. We want to lose less of our taxes. All right, great tax discussion, guys. Before we go, let's talk about the economy and again, Iran and what you're watching this week with the Fed getting ready to meet next week. What's on your radar right now?
The main thing we're watching, which is a very micro data thing, is actually the number of crossings through the Straits of Hormuz. That sounds like real esoteric stuff, but it's moving the oil price very much, and it's moving the market as a result. So just to give you an example, oil was way down to $80 this morning because there was a report that the Navy escorted a ship through the Strait of Hormuz. So normally there's like 70 ships going through every day. Now we're down to one ship. And so that statement was later retracted. And just now, someone from the Iranian Republican Guard said that no ship passed. And in that time, literally in the last 5 minutes on this show, oil prices went up $7, and the S&P went from up 35 to now down 3. So that gives you a sense of how sensitive the market is to the ability for oil to flow. And so that's what we're watching right now.
Sounds like an esoteric answer, but clearly a real-time market impact there, Urian. I think that's the first from you from a Timmer's Take being so specific, but important to watch. And we will, I just quick programming note, we will be talking with a Fidelity portfolio manager in the energy and oil space next week alongside Urian. So I'm excited for that conversation, and feel free at registration time to submit your questions for our energy expert next week. For this conversation, though, we got to leave it at that. And Travis and Urian, terrific discussion today. Just a quick reminder, we don't provide tax advice here at Fidelity, but our partners at Fidelity Viewpoint have created a wealth of articles around tax education and covering some of the tax topics that we mentioned today. And you can find those articles at fidelity.com/managing taxes. On behalf of Urian Timmer and Travis Furland, I'm Heather Hedges. Hoping to see you back here next week when we do talk more about the geopolitics and the latest developments in Iran. We are on live Tuesday at 2 Eastern and wherever you get your podcasts.